Reno wasn't supposed to be the next big real estate story. For decades, it was the little city by the river. Gambling, a few conventions, and scenic mountains on the horizon. But in the past 10 years, the script flipped. Tech factories, logistics hubs, and a growing workforce rewrote local demand. Today, investors are moving capital into Reno not because it's cheap alone, but because affordability, job growth, and a tax-friendly environment create a fast lane for returns. In this report, we'll show where money is flowing, why it's flowing, and what every investor must know before they buy.
Reno's story is a macro story. Major employers, from advanced manufacturing to cloud data centers, have planted campuses that demand both blue and white-collar workers. That jobs growth ripples to housing, more renters, rising rents, and renewed development. On top of that, Nevada's tax structure, notably no state income tax and comparatively low property tax rates, magnifies investor yield versus many West Coast alternatives. Add lifestyle pull, Lake Tahoe recreational access, and you've got a market where both short-term rental tourism and long-term tenancy find buyers.
Affordability is the signal most investors hear first. Reno's entry prices remain lower than many coastal markets, while appreciation has outpaced many peers in recent cycles. That combination, lower base price plus steady appreciation, is attractive for buy-and-hold strategies and for value-add renovations that flip to higher rents. But it's not without nuance. Neighborhood choice, local school ratings, and supply pipelines matter. Some pockets show strong long-term fundamentals, while others are better for short-term holiday rentals near Tahoe.
Investors don't buy Reno, they buy neighborhoods. South Reno has emerged as a family-oriented stronghold. Lower crime, better schools, and new developments that attract long-term renters. Midtown and Old Southwest offer character, walkability, and strong short-term demand from younger renters, restaurants, and repurposed historic buildings. Outlying pockets, Spanish Springs and Cold Springs, give affordability plus upside as commuters push outward. We'll explore each area's risk profile and yield expectations in the following sections.
South Reno is where many investors start their search for stability. This sprawling suburban pocket combines newer master-planned communities with better-performing schools and lower crime rates, features that draw long-term renters and owner-occupiers alike. Developers continue to build single-family subdivisions and townhome complexes here, creating new inventory that still rents quickly. For buy-and-hold portfolios, South Reno's steady demand translates to lower vacancy and predictable cash flow, though cap rates are correspondingly tighter than in outlying suburbs. Put simply, pay a premium for less volatility.
Midtown and Old Southwest sell a story of character and walkability. Historic brick buildings, cafes, craft breweries, and parks. Those lifestyle ingredients attract younger renters and short-term demand, which is excellent for investors targeting higher rents or furnished rentals. But higher turnover and occasional noise complaints are real management considerations, and properties here often need renovation to reach premium rents. Investors who specialize in value-add, small multifamily or short-term furnished units tend to outperform in these districts, provided they budget for active management and frequent refreshes.
Spanish Springs and Cold Springs represent the classic move-out play. Lower purchase prices, more land, and the potential for stronger percentage appreciation as growth radiates outward. These pockets are popular with buyers priced out of Reno proper, and local developments, from infill subdivisions to new retail nodes, are slowly reshaping their economics. The trade-off is commute time and a less dense tenant pool, which can mean longer initial leasing cycles. For investors focused on long-term appreciation or lot flips, these areas can deliver outsized percentage returns, especially where new infrastructure is announced.
Reno's tourism backdrop, proximity to Lake Tahoe, festivals, and outdoor recreation powers a viable short-term rental market. Investors can command premium nightly rates near event hubs and recreation corridors, but this strategy comes with seasonality, regulatory risk, and higher operating costs. Effective hosts budget aggressively for management, cleaning, and vacancy buffers. They also track local regulations closely as municipalities tweak short-term rules. For many portfolios, a blended strategy, mixing stable long-term units with a small short-term allocation near Tahoe or downtown, hedges seasonality while capturing upside.
When evaluating a Reno deal, the headline matters, but the comps decide how you underwrite it. Compare recent sold prices for similar properties, time on market, and rent comps from nearby listings. Don't just look at the city average. Compare micro-markets, a South Reno subdivision, an old Southwest bungalow, and a Midtown small multifamily can show very different cap rate and turnover profiles. Also compare days on market and percent of list price sold to sense momentum. Finally, overlay planned infrastructure and large employer expansions. Those moves change comps before listing agents do. Use local MLS and property management feedback to validate your assumptions. Here's a worked example, an illustrative pro forma for a 4-unit buy and hold in Reno. These numbers are hypothetical. Use local comps to replace them, but the structure is the roadmap you'll use. Purchase price, $700,000. Gross monthly rents, all units, $6,400. Allow 8% vacancy and a 35% operating expense ratio, management, repairs, insurance, taxes. With a 25% down loan at market rates, the all-in cash flow, cap rate, and cash-on-cash yield determine viability. Use the sensitivity column. Run 3 rent and 3 capex scenarios to stress test your returns before you sign any contract. This is the template pro investors use to avoid surprises.
Cap rate is the shorthand for how the market values income. It's NOI divided by purchase price. But financing and leverage change the story for investors. A lower cap rate in South Reno often buys stability. Higher cap rates in outlying areas buy upside. When you add leverage, cash-on-cash return can rise even as cap rate falls, but debt service coverage ratios and interest rate risk become central. Always run a debt service sensitivity for plus 200 to 300 basis points of rate shock and underwrite with conservative rent assumptions. In Reno's market environment, underwriting for vacancy and active management preserves downside.
Short-term momentum matters for timing. Watch year-to-date price movement, new listings velocity, and rental rate changes. Your PDFs point to steady appreciation and demand driven by job growth and tax advantages. That's the structural backdrop, but momentum lives in the listings feed and rent roll. If YTD sold prices compress versus list prices, negotiating leverage increases. Conversely, a tightening rental market signals immediate yield improvement. For actionable rhythm, pull a weekly new listings versus pending versus sold snapshot from the MLS and track the 3-week moving average to sense acceleration or cooling. Dig into street-level price bands and you'll see Reno is a tapestry, not a single color. Within South Reno, entry-level detached homes often sit in a different band than newer townhomes, and Old Southwest shows a wide band because historic bungalows sit steps from high-end estates. For comp work, group by street or block when possible. Narrower radius equals cleaner comps. Pay attention to recent remodel flags. A single kitchen remodel can lift comparable rents and sold price materially. Use a 6 to 12-month sold window for active neighborhoods. Extend to 18 months for the fringe. Those subtleties turn a good deal into a great one.
Reno's renter base is diverse. Tech employees and contractors from nearby campuses, hospitality and service workers tied to tourism, young professionals drawn to Midtown scene, and families in South Reno seeking stability. Each persona demands different units and management. Tech professionals prefer modern amenities and high-speed internet. Hospitality workers prioritize affordability and proximity to job nodes. Young professionals favor walkability and furnished units. Families want schools, yards, and longer leases. Match unit type and amenity packages to targeted personas, and your turnover, maintenance, and pricing assumptions will align, which improves underwriting accuracy.
Interviews add credibility. Here are quick, sharp questions for on-camera agents and property managers that plug directly into your documentary. Ask agents, what neighborhood has surprised you this year and why? How long are well-priced listings staying on market? And what concessions are buyers currently asking for? For property managers, ask, what turnover costs should new investors budget? Which tenant persona is hardest to retain? And are short-term rentals creating management friction? Use snappy edits and overlay the interviewee's name and role. Keep clips short, 10 to 20 seconds, and use them to punctuate the data you present. Budgeting for property management and real operating costs separates wishful underwriting from reality. Management fees in Reno commonly range from 6 to 10% for residential portfolios. Add turnover advertising, cleaning, and average repair reserves. Insurance costs and local property tax nuances matter. Nevada's low income tax helps investors, but property tax and special assessments vary by parcel. Use conservative OPEX assumptions. We recommended 30 to 40% earlier in the pro forma example, and request a sample management P&L from prospective managers before you commit. Professional management often reduces vacancy and legal errors, which can pay for itself in tighter markets.
Regulation and zoning quietly reshape returns. In Reno and surrounding Washoe County, zoning determines where duplexes, short-term rentals, and infill can be built, and where they can't. Some neighborhoods have historic overlays that limit exterior changes and can increase renovation costs. Others are more permissive for ADUs and small multifamily. Short-term rental rules are actively reviewed in many Nevada jurisdictions, so hosts should assume periodic adjustments to licensing, occupancy limits, and tax collection requirements. Always check parcel-level zoning and contact the planning department before budgeting CapEx. It's the fastest way to avoid a deal-killing surprise.
Every investor must plan the exit before they buy. Common exits in Reno include 1. Hold and cash flow, 2. Refinance and hold after value add, or 3. Sell to an owner-occupier or small operator when comps mature. Risk managers recommend building a playbook, minimum acceptable cap rate, acceptable vacancy threshold, and a timeline for forced sale if rehab overruns occur. Hedging for interest rate variability, for example, having 6 to 12 months of reserves to cover debt service shock, is essential today. Finally, document an exit trigger, a CapEx overruns threshold, or a personal liquidity date. Without an exit plan, upside quickly becomes an unmanageable tail risk.
Value add remains one of the fastest ways to create returns in Reno, but only when scope and cost are controlled. Typical high ROI projects include kitchen and bathroom updates, adding in-unit laundry, energy-efficient HVAC upgrades, and curb appeal improvements. Exterior repairs that unlock permitted ADU or accessory units can materially increase rents and cap rate upon exit. Successful renovators price the job with 3 quotes, add a 10 to 20% contingency, and sequence work to re-rent units quickly. When you pair smart CapEx with targeted rent bumps, the math for refinance or sale improves dramatically, but sloppy rehabs destroy returns faster than any market move.
Nevada's tax environment is a headline advantage, no state income tax. But there are additional incentives worth hunting for. Some redevelopment zones and local economic programs offer impact credits or expedited permitting for projects that add housing or revitalize commercial corridors. For some investors, 1031 exchange strategies and accelerated depreciation on qualified improvements amplify after-tax returns. Always work with a local CPA to confirm treatment. Remember, municipal fees, special assessments, and parcel-level property tax differences can offset headline benefits,
So run after-tax cash flow with parcel-specific tax inputs before you sign.
Energy and infrastructure are background variables that show up in returns. Nevada's grid investments, growing data center demand, and renewables projects can change utility profiles and operating costs for landlords. For example, upgraded electrical infrastructure reduces the friction and cost of adding EV chargers or ADUs. Road and transit projects that shorten commutes materially change effective rent catchment areas. For investors, monitor planned utility upgrades and capital projects at the county level. Sometimes a utility easement or road improvement is the catalyst that unlocks a whole submarket.
Pay attention to who's buying: locals, mom-and-pop investors, or institutions and out-of-state funds. In Reno's case, the last decade saw a mix: local developers building subdivisions and larger capital players buying multifamily and land for speculative plays tied to industrial growth. Institutional entry tightens cap rates and raises competition for off-market deals. It also brings due diligence rigor that professionalizes pricing. For individual investors, this means monitoring both public land deals and trades reported in local broker notes. Institutional footprints foreshadow neighborhood re-ratings.
Climate and resilience are no longer afterthoughts. Reno's mountain-adjacent location offers lifestyle upside, but also places some parcels within wildfire risk corridors and seasonal water stress areas. Energy efficiency, defensible landscaping, and resilient HVAC systems not only lower operating costs, but also improve marketability to risk-aware tenants and institutional buyers. Consider water risk in landscaping choices and insurance premiums when underwriting. Green certifications and solar retrofits can improve NOI and appeal, and sometimes qualify for local incentive programs, so include resilience in both CapEx planning and exit positioning.
Here's a short checklist to run before you sign. 1. Confirm parcel-level zoning and short-term rental rules. 2. Pull 6 to 18-month comps and rent roll. 3. Order a site walk with a contractor for a 3-quote estimate and include a 10 to 20% contingency. 4. Run debt service sensitivity for plus 200 to 300 BPS. 5. Verify insurance and municipal assessments. 6. Confirm local property management with sample P&L. 7. Document your exit triggers. If you run this checklist consistently, you convert hopeful deals into repeatable, defensible investments.
Reno's rise is not an accident. Strategic employers, tax advantages, affordability relative to coastal neighbors, and a lifestyle that blends urban convenience with outdoor access created a compelling mix. But good investment is local. It's about the street, the parcel, the tenant, and the contingency plans you build. If you take one thing from this report, let it be discipline. Underwrite conservatively, verify locally, and always plan an exit. Subscribe for more updated Nevada real estate report. Follow local brokers' notes, and if you're active in Reno, walk the blocks. The market rewards those who show up prepared.